Welcome to another episode of The Dana Yee Show. I'm Dana, and in this video, I'm going to cover things that you should know before you start investing or trading. Although I say before, this still applies even if you've already traded or already invested. These are things that you probably should know and keep in mind. As a side note, I saw this in a YouTube comment where someone was basically like, oh, how do I get started? And I thought that was a really good topic to cover. So if you have any topics you'd like me to cover, make sure to leave it down below or just comment so I can say hi. I will split this into two sections, one on investing and trading. I already have a video on what the differences between the two are because these are inherently different, so the approaches should be different. I think the biggest piece of advice that would actually apply to both investing and trading is to learn before you get started. It seems kind of obvious, right? But a lot of people jump into investing or trading without really knowing what they're doing, and when there's significant financial risk, it can be, well, dangerous. And I also do want to say a lot of these things, I've made mistakes at the beginning, so maybe I'll tell little stories about what I wish I'd known at the beginning or what I could have done differently. Firstly, for investing, in terms of the order of accounts you should open, if that makes sense, I think the first account you should open is a Roth IRA, followed by some sort of employer-sponsored account, so 401k, 403b, 401k Roth, whatever. And then after you have those things set up, open a taxable brokerage account. And the reason I say this is because Roth IRAs and 401ks and other employer-sponsored accounts have tax benefits, whereas a brokerage account does not. And a lot of employer-sponsored accounts have what are called matches. So if you put in, say, $100, they match you with $50, which is basically free money. Secondly, for investing, if you want to be minimum effort, I'd recommend ETFs or index funds. These are really, really passive. They're buy it, set it and forget it, and they have pretty reliable returns. So some examples are VOO, which is Vanguard's ETF that tracks the S&P 500, which is made up of the 500 largest companies in the United States. Some other examples are the QQQ, which tracks the NASDAQ composite, which is made up of more tech-focused stocks. And I did briefly mention this, but these are good because these are the lowest effort way to get into investing. You literally just buy a huge group of stocks that are generally successful, or depending on whatever indice you're looking at. And historically, index fund and ETF investing has done really, really well. I think in the history of the US stock market, at least, there hasn't been a market-wide decline for over 20 years. So it's not guaranteed, of course, because nothing in the stock market is guaranteed, but based on historical evidence, pretty much anytime you start, 20 years from now, the entire market will be higher, which you will benefit from if you have index funds or broad market funds. A third really important thing for investing that I don't think a lot of people talk about is how you fund your investments. And my philosophy for this is that it should be slow and continuous over time. I say slow because you don't need to have a huge portfolio at the very beginning, and you don't need to have a ton of cash sitting around before you start investing. You can literally get started on a lot of platforms with as little as like $1. Additionally, I think you should continuously fund your account over time, so maybe weekly installments or monthly installments instead of one huge installment every year or something, because this allows you to average into the market and continue to buy companies that you really, really like. Fourth, if you are like myself and want to pick your own companies, make sure to learn how to analyze companies. I will say at the very beginning, I sort of just picked companies I liked and was like, you know what, let's just have all of these, which honestly wasn't a bad approach because I did end up picking pretty decent companies. But over time, I felt stronger in those investments because I learned how to analyze those companies from a financial perspective. And fourthly, for investing is to keep a long-term horizon. It seems simple to say, it seems pretty obvious, but when emotions and money are involved, it can get difficult. I definitely made this mistake at the beginning. I bought companies I really liked. I saw them go up 5%. I was like, oh my God, sell before it goes down. Whereas I picked those companies as long-term investments and I definitely sold them earlier than I should have. Now on to trading, which is completely different from investing. Don't get the two mixed up. Check out this video here I have explaining the difference between the two. Like I mentioned earlier, both for trading and investing, one of the most important things is to learn. And for trading, that manifests itself in reading books and watching a lot of videos. I will leave some books that I read here because I don't remember the names off the top of my head, and a few YouTube channels that have videos of trade recaps or live trades that I really enjoy. I really learned a lot from. Secondly, for trading, a huge thing is to just observe the markets. It's so tempting to, once you learn how to trade, okay, I just buy, sell, right? And then you just hop into the market. But it's so important to watch how stocks move, especially specific stocks, how they move in response to certain types of news and things like that. For me, my favorite two stocks to trade are Amazon and Tesla. And I watched Tesla for, I think, about a month before I actually traded it, just watching it move up and down on the 1-minute candles. Thirdly, for trading, make sure to start small. It's so tempting to go in big because you can make big returns, lots of money, become rich overnight. But when emotions get involved and money is involved, it gets very, very difficult. Building off my previous example for Tesla, after watching it for about a month, I traded one options contract at a time, which basically allowed me to get my feet wet, so to speak. And generally with just one contract, you can't make a ridiculous amount of money, but on the flip side, you generally can't lose a ridiculous amount of money, so it's a really good way to get into things. After you've observed the markets and started started trading small, make sure to scale up slowly. Scale up just means take bigger size. So if you're trading one contract, trade 2 or more, because that's more than one. And I say slowly size up because I definitely made this error once at the beginning. For example, I was trading one contract for a while and then I was like, you know what? I can do this. Let's go to 4. But I was not ready for those emotions. So instead of going from 1 to 4, go 1 to 2 to 3 to 4. Because I would say trading is 80% emotional. And when you size up like that, your emotions can get in the way of making good decisions. Another thing for trading is to have proper risk management. Whether this means if you are doing a small YOLOing an amount that you would not mind losing instead of your entire life savings. Or if you're scalping, don't just hold onto a stock if it's losing. Know when you're going to get out for a loss, because sometimes it's better to take a small loss than a really, really big loss, obviously. And sort of following from that, make sure to step away when you feel your emotions get heightened. I definitely felt this a lot at the very beginning. If I had a losing day, sometimes I would make it worse because I really wanted to make back the money, and then it just goes from a little red to very, very big red. Honestly, thinking about these points, a lot of them are about controlling and managing your emotions when trading, which makes a lot of sense. And the reason you need to control your emotions is basically the market doesn't care about you. If you lose money and you lose more money, the market really doesn't care. It'll take more money from you. You could make a ton of money a day and the market just keeps giving it to you. So I guess for trading, again, the biggest things is to learn and then keep your emotions in check. So that was a list of, I guess, things I wish I knew before I started investing in trading. Is there anything you wish you had known when you had started? Or if you are starting, are there any questions you have of things I didn't mention? If you watched to this far in the video, you are awesome. I'm giving you air high fives, and I'll see you guys soon.